Ladies and gentlemen, good day and welcome to Apparel Limited Q2FY25 earnings conference call, hosted by Elara Securities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Prerna Jhunjhunwala from Elara Securities Private Limited. Thank you, and over to you, ma'am.
Thank you, Manav. Good afternoon, everyone. On behalf of Elara Securities Private Limited, I would like to welcome you all to Q2FY25 post-result conference call and business update call of Apparels Limited. Today, we have with us the senior management of the company, including Mr. P. Sundararajan, Chairman and Managing Director, Mr. S. Chenduran, Joint Managing Director, Ms. S. Shanta, Joint Managing Director, Mrs. S. Lata, Executive Director, Mrs. P.V. Jiva, CEO, and Mr. V. Balaji, Chief Financial Officer of the company. I would now like to hand over the call to the management for opening remarks. Thank you, and over to you, sir.
Thank you, Prerna. Good afternoon, everyone. I welcome you all to the post-earning conference call for Q2 and H1FY25 of Apparels Limited. I hope all of you had a chance to look at our investor presentation that is uploaded on the company's website and at the stock exchanges. The Indian textile sector is currently experiencing favorable conditions in the global market. As international retailers adopt the China Plus One and Bangladesh Plus One strategy, India has become a key sourcing destination. This shift is driven by a desire to mitigate risk and diversify supply chains, moving away from traditional markets. In response to this shift, American and European companies are actively looking for alternatives to Chinese raw materials. This trend, coupled with India's growing capacity and infrastructure, has allowed garment exporters to significantly increase their production capabilities to cater to this demand. We are seeing this trend gain momentum with a few prominent customers who are actively encouraging their importers to shift sourcing away from China to India. Similarly, U.S. importers are also showing a keen interest in placing orders with India, signaling a positive growth outlook for our market. Moreover, India, alongside Vietnam and Sri Lanka, is emerging as a sourcing destination, reflecting a shift in preference from China and Bangladesh. These economic shifts are beneficial for us as we are eager to take advantage of these opportunities. To do so, we are implementing strategic measures such as maximizing the utilization of our current capacities, and have also begun to attract interest from new customers who are ready to place orders with us. Coming to our business performance, at our spinning division, we have faced some hurdles in the past, particularly due to the volatility in cotton prices. However, cotton prices have stabilized on a lower side now, enabling us to maintain the profitability. Additionally, our dyeing facility has reached 95% utilization rate, enhancing the efficiency and performance of this segment. In the garment division, we have made significant strides in our operational efficiency. Our capacity utilization has increased to 82% in Q2 FY25, up from 79% in Q1 FY25. Historically, our utilization rates were between 72% to 74%, which has currently increased to 84%. And we are on track to achieve our target of 90% utilization by March 2025. During this quarter, employee expenses were higher due to the recruitment of new workmen, which improved our utilization rate. However, production efficiency was not at its peak, since these employees are still in the early stages of their training. Over the time, we expect their productivity to improve. Additionally, the necessity to expedite certain orders via air transport led to increased air freight costs, which affected our operational margins for the quarter. Turning to our recent acquisition of Young Brand Apparels, which is a significant milestone in SP Apparel's journey and brings substantial potential for growth. We have identified several areas for improvement that will enhance margins, with full control over the workforce, production efficiency, order booking, raw material sourcing, and overheads. Our goal is to improve margins by 4 to 5% in the upcoming years. Currently, out of 1,500 machines, we have achieved 74% utilization rate, and by end of March 2025, we anticipate it to increase to 92.5% with 1,400 machines in utilization. Additionally, we plan to expand the capacity of the Young Brand by adding 300 machines in the next 2 years. With regard to customers, SPFL has traditionally been concentrating in European and UK markets. However, the acquisition of Young Brand has opened doors to the American market, where the brand enjoys a strong reputation. This has led to increased interest for American customers in SPFL's fashion products, demonstrating effective synergy between SPAL and Young Brand. In Young Brand, we anticipate some initial impact on EBITDA margins, but we are optimistic in reaching our goal of 18% margin in the garment division, including Young Brand. Going forward, the numbers of Young Brand will be combined with SPAL's numbers under garment division for presentation purpose. Furthermore, we are happy to share that training of workmen at Sivakasi unit has been started, and we expect this to operate efficiently by in the next 12 to 15 months' time. Our current order book is 512 crores, where 402 crores from SPAL and 110 crores from Young Brand. Looking at the garment division's performance, the adjusted revenue was rupees 257.5 crores, with an adjusted EBITDA of rupees 43.9 crores and an EBITDA margin of 17.1%. Moving towards our subsidiary in Sri Lanka, which is an asset-light business model with high ROEs, has already started yielding positive results. The operations in Sri Lanka are enhancing our capacity without additional investment in assets. We have onboarded new customers of wholesale US importers in our customer profile, which aligns with our expanded capacity and growth in customer volume. In the retail division, SP Retail Ventures reported revenue of 22.5 crores during the quarter, compared to 27.6 crores in Q2 of FY24. I am excited to announce that our Crocodile brand has reached that break-even point this quarter with a top line of 22.5 crores despite a nominal loss. We expect the retail division to achieve a break-even status by end of FY25. Additionally, we have made the strategic decision to discontinue the head brand with the license set to expire in December 2024. We are actively exploring fundraise opportunities for our retail venture, including participation from existing shareholders. With regard to SP UK, our revenue for Q2 FY25 was GBP 1.83 million, and current order book is valued at GBP 5.01 million. At the SP UK, we are experiencing a revival. After a year of transition involving office relocation and team restructuring, including the integration of new generation of designers. We are now back on track. I am pleased to share that in H1FY25, we secured two new customers, and we have 2 additional customers to be signed up this financial year. We are confident of the growth of this division in FY26. Now, we recognize our team's contribution to our success, for which we have launched Employee Stock Ownership Plans, ESOPs, as a token of appreciation. This initiative aims to reward their hard work and foster a sense of ownership, aligning their interests with company's future growth. Looking forward, we anticipate improvement in margins with our aim to reach 18% EBITDA margin in garment division. By March 2025, we expect to have an average of 4,200 machines running, up from 3,600 machines in FY24, marking a significant increase of 18% growth in the capacity utilization. Moreover, our recent investment in expanding capacities have enhanced our ability to grow, allowing us to seize new opportunities and provide strong value to our stakeholders. These efforts, along with supportive market trends, are set to contribute to our company's expansion in the coming years. Thank you, and over to Mr. Balaji, our CFO.
Thank you, sir. Good afternoon, everybody. I'll just run through the financial performance of the company. On a standalone basis, we have recorded a revenue of 257 crores on an adjusted total revenue basis. And at the adjusted EBITDA, we have recorded 44 crores, which is at 17.1%. And at the PAT level, we have recorded 18 crores of PAT at 7%. And for the first half, we have done 471 crores with 80 crores of EBITDA, which is at 17%, and a PAT of 40 crores, which is at 8.7%. On a consolidated basis, for the second quarter, we have done 393 crores, which is at a growth rate of 32.1%, at an EBITDA of 52 crores. This is an EBITDA, not an adjusted EBITDA, which is at 52 crores, which is 13.2%, and a PAT of 21.9 crores, which is at 5.6%. On the first half, on a consolidated basis, we have done 641 crores with an EBITDA of 87.8 crores, which is at 13.7%. And we have done 40 crores of PAT at 6.2%. On the the division-wise performance, on the garment division, we have done 257.5 crores with an 44 crores of EBITDA at 17.1% for the current quarter. For the first half, we have done 471 crores with 80 crores of EBITDA, which is at 17%. For SP UK, we have done 19.9 crores of top line with an EBITDA negative of 1.1 crores. And at the retail division, we have done 22.5 crores for the current quarter with an EBITDA of 8.8 lakhs negative number. And in terms of our debt, on a standalone basis, our gross debt stands at 167 crores and net debt stands at 137 crores. And on a consolidated basis, our gross debt stands at 299 crores and net debt stands at 241 crores, which is 0.3 on debt equity and 1 time of EBITDA. Other data which is available in the presentation, we can get into the question and answer session. Hello?
Yes, sir. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets only while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have our first question from the line of Bharat Seth from Quest Investment. Please go ahead.
Good morning, sir. Hello.
Yeah, good afternoon, sir.
Yeah, sorry. Good afternoon. So, am I audible, sir? Just taking back over.
You need to be louder, sir.
Okay. Now, is it clearly audible?
Little more louder, please.
Okay. Hello. Sir, my question is related to our US market. So, how many customers as of now we have, and when we are seeing, as per our MD remark, kind of a traction. So, what is our strategy and how do we plan to encash that opportunity currently available from US market?
Yeah. So currently in SPAL, we have about 6 customers, and we are in the process of increasing the customer base. And in addition to that, American customers from young brands, they are also open for fashion businesses. And in addition to that, there are certain basic orders, styles, where there is a requirement from US market into India is becoming more, like Walmart importers and all. And young brand has got limited capacities which will be completely filled, whereas they want more orders to be placed. So what we are planning is that any additional orders numbers can be taken by SPAL. That is one way of increasing the customer base and the top line also. In addition to that, through them, we will be getting more importers from the US, which will, gradually the number of customers will increase over a period of time. So by in the next 2 years' time, put together SPAL and young brand, we will be having 10 to 15 customer base.
And what is the kind of, potential that we anticipate that will be able to really reach US sales, on SPAL and brand both put together?
You mean in numbers?
Yeah. A broader, ballpark figure.
So it is like, our sales top line grows only along with the number of machines, the utilization. So the more the numbers, the more the orders, because filling the capacities has never been a problem. So why we are increasing the customer base is to see that there is a possibility of improving the margins by having more customers. And as our continuous effort is to increase the capacity. So over a period of 2 years' time, we have put together young brand and the Apparels put together. We expect at least about 7,000 to 8,000 machines.
Okay, great. And sir, and profitability-wise, how is the US market vis-a-vis this European and UK market?
See, the profitability, because of volume, American market, we would be able to improve a margin a little bit. But still, the price pressure is always there in both regions.
Okay. And on SP Apparel and End Brand put together, how much, sir, contribution is coming from the fashion and how much is currently at the basic side?
Contribution of? Babies. No.
Revenue distribution between
SP Apparel. In young brand, it is only adult products.
Sir, fashion product and a basic product, that my question is. Like Primark is a basic, correct?
No, it's a mix. For all customers, there is a mix of basic and fashion product. In SP Apparel, the fashion product is about 60 to 70%, and the rest all in a basic product. But whereas in young brand, it is only the undergarment. There is no fashion or there is no basic.
Okay.
Everything is essential, basic only.
And taking further, I mean, sir, this SP UK, the way we are playing out, so can that SP UK kind of again one more, I mean, venture can help us, I mean, to grow into the US market, like sourcing from India and selling, distributing to the American end user?
Through SP UK, you mean?
Either SP UK or separate subsidiary, sir.
No. We have a plan. We are not ruling it out. We are planning SP UK office to foot into American market as well, to contact some of the retailers, and they can source from India and Sri Lanka for US market, which we are not ruling it out. We might have an office in the US also. It's too early to comment anything on that.
Okay. And last question, sir, on Sri Lanka side, how the things are playing out our experiment with the Sri Lankan outsourcing market?
Yeah, Sri Lanka, see, we have already started the production. The first shipment is yet to go. So far, everything is going good in line with our requirements. And as I mentioned in my speech, that we have a plan for increasing up to 2,000 machines over a period of 2 years' time. So without any investment into assets, so this will fetch additional extra businesses, and we have to mitigate only the margins, which shouldn't be a problem.
Margin to the extent of asset light. Is that fair understanding?
Yeah, if it is asset light, if you look at it, yes, the ratios will be better, but margin will be tight because, the labor cost is slightly higher there, but the production efficiency is better. Our ROCE will be better.
ROSCPL.
ROSCPL. Oh, you're talking about ROSCPL. Yeah, so we have to compromise on the ROSCPL, and that is the reason why, there will be a pressure on margins. But overall, it will, as a company, it will fetch better ratios to the numbers.
Okay, so then last question on the retail side, how do we really, as you said that from existing shareholder, so are we also planning to put the money in this retail business?
See, currently the idea is to raise money in the retail division where the debt portion will come down and the margins will definitely improve. So it's currently in the discussion stage. Nothing is being finalized so far.
No, but if required, I mean, SP Apparel is ready to put the money, also additional money in this our retail venture again?
No. We are trying to raise money from outside. Chairman spoke about getting money from the existing shareholders of SP Apparels.
Okay. Thank you and all the best.
Thank you.
Thank you, sir. We have our next question from the line of Aman Agarwal from Carnelian Capital. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. A few questions from my side, basically starting on the spinning division. So, sir, how much utilization are we operating currently, and are we EBITDA break-even? How is the profitability in spinning division right now, sir?
Spinning utilization is full.
Spinning utilization is in full, and 95% is consumed by it is capital consumed, and moreover the efficiency levels are better now, and the margins are around 14-15% at the division stage. EBITDA percentage.
14-15% EBITDA margins, right, sir?
At the division stage.
Okay, got it. So, sir, if that's the case, what was the main reason for current decline in garment margins? We alluded to higher employee cost, but still, with spinning doing well, we get a kicker in overall garment margins, right? So, why was garment margins at 17% compared to historical level of 18-20% for us. So like anything on that, sir?
Two things. See, if you look at the EBITDA margins in terms of percentage, we have been guiding for 18%, and now there is a reduction in margin. Is one because of the air freight cost, which has a significant impact because of 6 crores for the first half is sitting in the expenses. Two, there is an increased employee cost because of the training where our utilization level has gone up and the training cost is sitting, and the spillover in terms of sales, whatever additions that has happened from Q1 to Q2 in terms of utilization level, the sales will get completed by Q3 and Q4. So spillover on sales has an impact on the margin. And third is on the training cost also. Like we have utilization level going up because there are a lot of trainees that have been utilized for training has been done. So there is an increased training cost. These are the three things which has impacted the EBITDA margins.
Thanks for the answer, sir. That was really elaborative in explaining. So again on the exports volume, like if I see our volumes have basically been flattish YOY, right? Garment exports for the standalone division. So with new training.
Can you speak a little louder, Aman?
Am I audible better now, sir?
Yeah.
Yeah. So I was talking about the garment exports volume. So like we have done 15.25 million units in this quarter. Compared to last year, it was flattish, right? So like even with new employees and higher capacity utilization, we had similar volumes. So like, have we seen increase in stock which might go in Q3, or like why are we not seeing increase in volumes despite the increase in utilization, sir?
Yeah, actually, Balaji have already explained to you, this the sales has been pushed to Q3 and Q4. So although the utilization is better, the sales will be pushed to Q3 and Q4. Overall, there will be an increase in growth in a year.
Okay, got it. One final question on young brands. Like we have reported 13.5-14% EBITDA margins in young brands. So like, will this be the recurring run rate for now? Like we are hoping for EBITDA margin expansion, like we are working towards that direction. But like this margins will stay stable from here on. Like this will be the minimum margins in young brands.
Yes. Yes. As I mentioned that this is any future quarters the result will be definitely better than what has been experienced now, and we expect over a period of few quarters, let's say 4 to 8 quarters. We are confident that the EBITDA margin can increase by another about 4%.
Got it. Thank you, sir. Thanks a lot.
Just to add to one point, it is only 1 quarter since we got, we have taken over control of young brand. So give us a couple of quarters to have complete control on the EBITDA margin. So I guess whatever chairman said is that we are working towards the improvement on the EBITDA margin.
Understood, sir. Thank you for answering my question, sir. This was really helpful. Thank you.
Thank you. We have our next question from the line of Resham Jain from DSP Asset Managers. Please go ahead.
Yeah, good afternoon, sir. So just 2-3 clarification. The first one is you had like close to 2-3% kind of garment growth in the first half, and our guidance at the beginning of the year in the last quarter was close to 10% for the full year. Do we still maintain that?
Yes.
Okay. Yeah, so it is like the first half is slightly more or less flat, but as we said that the deliveries of Q1 and Q2 are pushed to Q3 and Q4. So we expect the overall FY25, we expect the same number of, the growth of about 10%.
Okay, so around 15% growth is what mathematically it comes for the second half.
The 10 to 15, between 10 to 15.
Okay.
So for the whole year, we are looking at 10 to 15%.
Yeah, okay. So And the second is that earlier, I think when we acquired this company, we thought of doing close to 300 odd crores in this new acquisition, Young Brands. But I think in this quarter, we did close to 94 crores. So is it that we have done better than our own kind of expectations here?
No, it was, the previous quarter, Q1, the top line was little lesser, which all been pushed to Q2. That is the reason why it has gone up. So we expect all put together for the whole year, it will be around 303 or 305 crores.
Okay. So close to 75 odd crores kind of run rate.
Yeah, between 75 to 80 crores.
Okay, understood. And sir, in this business, again, when we took over, I think the margin was close to 10-11%. When I look at the numbers, it seems that this quarter you have already done 13.5%, 13.8. Again, some of the benefits have already started flowing through?
Yes, definitely. See, because, although officially we took over the possession by end of June, but I have started intervening into their thing for the past about, even before acquisition, of about 3 months or so, and I used to push the previous CFO and the sales team to improve the margins, and we have shared our expertise to them. So this has yielded the result, and now we have jumped into the operations now, and we know which are the areas to be plugged in, and I could easily see straight away 4% improvement over a period of time. It's not by just customer increase the price or something. The efficient way of working in terms of purchase, the sourcing, supply base, and the excessive employment of staff and above, and the expenses are abnormally high, and a lot of other areas, where the leakages needs to be plugged in. So a lot of things we could do, and forex hedging, that will fetch another about 1 or 2%. So many areas needs to be addressed. We have identified the areas, and we need to plug them over a period of time. All of a sudden, we cannot do it.
So one more point to add up here, as Sir spoke about first quarter sales being pushed into the second quarter. So the economics of scale is working out in terms of increased margin. So if you look at for the first half as such, we should be anywhere between 12.5 to 13%.
Yeah, that's a good point. See, because the sale of second quarter is slightly higher, so the EBITDA has shown another 1 to 2% better. So if you average it to H1, it will be more or less 11 to 12%.
Understood. Clear, sir. So the last question is, this year, if we just look at the normalized sales of Young Brand, on an annualized basis, we will be doing close to 1,330 odd crores kind of revenue in the garmenting business. On that base, with Shivakashi coming in and some improvement further in Young Brands and some of the old facilities getting ramped up, what kind of growth are we expecting in 26 on this 1330 kind of FY25 garmenting number?
I think you are looking at the consolidated numbers of Shivakashi, SPAL and Young Brand, correct?
Yes.
Yeah,
Everything
put
put
it this
together.
way, SPAL, there will be a growth of say 10% next year. That will come to say around 1,100 crores of the export. And Young Brand, we are targeting at 325 crores. So that will add up on 1,100 plus 300 1,425, which includes Shivakashi for SPAL. So close to 1,500 crores.
Okay. And anything from Sri Lanka?
Including Sri Lanka, we said SPAL is part of Sri Lanka is part of SPAL. Put together, we say 1,100 crores.
Okay. So Sri Lanka will not be very large in 26.
Yeah, because now in the early stage, we have to gradually step in.
Okay.
Resham, here Mr. Sundar is talking about 1,100 crores on absolute exports, and you will have the duty drawback, all other things along with it, that is where he said we will reach 1,500.
Understood. Clear, sir. Okay. Thank you. All the best.
Thank you.
Thank you. We have our next question from the line of Rehan from Equity Capital. Please go ahead.
Hi, good afternoon. Am I audible?
Yeah. You can be a little closer to the mic, yeah.
Okay. Is it better now?
Yeah.
Okay. On the labor front, I wanted to understand this higher labor cost. Are we hiring this labor to prepare for Sivakasi, or is it because we're trying to ramp up our utilization to ensure 90%, as the MD said as well, that we're trying to achieve 90% by March in the coming quarter, 2 quarters. So is this labor cost going to be relatively higher on these 2 accounts, or can you throw some more light on it?
Yeah, exactly. For Sivakasi also, we started recruiting people from this week. And as you said, with the migrants, we are going to increase the utilization to 90 plus. So we have to recruit them and train them before 1 quarter at least. So we started doing that. Because of that, there is an increase in labor cost.
Okay. So this includes the Sivakasi recruiting as well, right?
Yes.
That's just we started 1 week before. So that will happen gradually. Whereas this migrant mobilization will be a little aggressive.
Okay. On the freight cost, I think Balaji sir mentioned there was a 6-7 crore freight cost. We do our sales on FOB basis. So do we expect, why is that impact on us, 6-7 crores?
Yeah, air freight cost is actually there was a delay in Q4 of last year. Because of that only it had impacted, and moreover the higher air freight cost normally would not have been so much because of Red Sea issue, the freight cost itself was on higher side. Now it is completely stopped.
No, but the delay was from our side because as per my understanding, all our shipments are on FOB basis. So the buyer would take care of the...
No. It's like this. See, normally in every quarter there will be a nominal air freight always there due to late deliveries, or sometimes customers will request for air freight at our cost. And this is, order is only FOB, but if our deliveries are late, they will ask us to air freight at our cost. And it is not something new. Always in every quarter there will be a nominal increase due to air freight. Of some orders we cannot be 100% accurate on dot on deliveries. So, but this time what happened, the air freight cost of all the airlines is 3 times what it used to be. So that is why, generally we used to, spend about 50 lakhs or 1 crore for each quarter. But whereas because of the hike in the air freight cost and with a little more air freight thing, this has, impacted the bottom line. Otherwise, all FOB, only late deliveries, customers we will negotiate, and if the customers accept extension, it's fine. Otherwise, we will have to air freight at our cost.
Understood. Thanks for that clarification, sir. It was very helpful.
Thank you.
On Young Brands Apparel, I have one more question. The gross margins have come down quarter on quarter. Can you tell us more on that as to why we've seen I think almost 4-5% gross margin difference?
See, in the beginning, we explained to you about the spillover of sales from Q1 to Q2, and say a certain portion of the value-added products could have been spilled over to Q2, and that's why there is some reduction in Q2 as gross margin.
Right. For SPAL, you said the Young Brand.
Young Brand, sorry. So Young Brand, the difference I think is about 6% broadly gross margin difference. Q2 is lower gross than Q1 despite higher top line. I know Q1 we couldn't have the entire consolidated.
It's purely because of the spillover of sales.
But so then how is that? That should be higher gross, right?
The higher gross, it is worse.
No.
Gross margin is 44 as against Q1 of 51. There was air freight, sorry, there was air freight, COGS.
Your cost of goods sold as
When I buy fabric and dye on it, then the dyeing cost is sitting in my COGS, but my expenses for dyeing is sitting on other expenses. So when I net off in COGS, the COGS will definitely be showing lower number. Other expenses will be sitting on the bottom line.
okay. So you're saying that COGS, can you re-explain that? It wasn't very clear.
I think the absorption costing is the issue here. Maybe we can take an off call and discuss on this separately.
Yeah, say for example, there are two ways of working. The raw material, either we buy finished fabric, or sometimes we buy the yarn, we send it for dyeing, and then we get it. So when we do the job, when we do ourselves for the dyeing and knitting, so that comes in the other expenses. If we buy a straight away outright purchase of fabric, it goes into COGS. So this, yeah, you can explain it later.
I think it needs to be a broader explanation on this. We can off call and discuss on this. Can I know the name, please?
Rehan from Equity Capital.
Equity. Okay. Raymond, we can take a call and I'll explain to you on this. Okay?
Okay. And sir, if you could also quantify the spinning EBITDA for the quarter. I couldn't hear that absolute figure for the quarter.
Sorry?
The absolute value of spinning in the quarter, EBITDA level.
Spinning EBITDA for the quarter, current quarter you are asking?
Yes, please.
Just hold on a minute.
Sure, sure.
For the first half, spinning EBITDA is around 7 crores 15 lakhs.
This is first half full.
First half, yeah.
So I think in Q1 we did around 50 lakhs to 1 crore, if I'm not wrong. So balance is in this quarter?
Could be somewhere around 1.5 crores or something. Now we have done 7.15.
Okay. And for FY25, I think you had given a guidance of around 1,200 to 1,300 crores top line. And I think we've done about...
Consolidated basis.
Yeah, for FY25, I'm just going to repeat myself.
Yeah, correct.
Yeah, so 1,200 crores top line in FY25, you've, I think, achieved about 600 odd crores in the first half, 640.
When we gave the guidance, it was Q4, I guess. We expected Q1 to be consolidated on the Young brand, but Young brand we didn't consolidate for Q1. So I guess we should be in line with the numbers whatever we have given in terms of 1,300 crores for the whole year FY25.
Okay. Okay. So you're saying 1,300, right, for the full year?
Yes. On a consolidated basis, yeah.
Yeah. Okay, that's fine. That's what if you even consider this run rate, it's more than that. My question is also on the volumes. I think for first half, if I take H1 FY24 versus H1 FY25, on the apparel business, the garment division, we've degrown in volumes by about 0.7 million pieces. Can you throw some light on why that is happening and because I think in either Q1 or Q4 you had mentioned that you expect volume growth of 7-8% on a YOY basis for the full year. So do you see that much volume difference to come out in the H2, or are we seeing a flattish year again?
If you look at our realization has gone up in spite of reduction in material cost.
The change of
So
price.
there is a product mix which has changed. But in terms of, if you have heard to the previous question which has come on the sales growth, we are expecting that the second half should be far better than the first half. So the sales should pick up in second half, whereby we should be in a position to end up on a 10% to 15% kind of growth for the whole year.
I'm talking about absolute sales growth. I'm asking you in volumes. The guidance you had given in Q4 or Q1 was 7-8% volumes. And to answer your question on realization, your realization has broadly been, 1-2 rupees difference. I'm looking at the PPT and saying, but volumes have been.
FY24 Q2, the material cost was on the higher side. The yarn prices have corrected. So in spite of correction in the yarn prices, we are able to maintain the same kind of, so there is a change in the product mix.
Correct, which is showing in your gross numbers. There's a 1.5% increase in gross numbers. I'm not asking that. My question is on absolute volumes. If you have done X amount of pieces, there are in H1 FY24. In H1 FY25, you have done 0.7 million less. I understand product mix change in absolute terms. I understand that completely. But at the aggregate basis for the whole year, you had mentioned that you do about 7% odd volume growth. So are you seeing in Q2 the volumes do well, or are you seeing realizations do well? That's my question.
We are expecting the volumes to go up.
Okay, that's broadly my question.
Yeah.
Understood. Okay. And Sivakasi, I think, sir, you had mentioned in the opening remarks, has started.
Yeah, the training has started, and we expect the production to start in the first week of January.
Okay, first week January we expect production. Okay. Thank you so much. Thank you for answering everything so patient. I really appreciate it.
Thank you.
Thank you. Ladies and gentlemen, you may press star and one to ask questions. I repeat, you may press star and one to ask questions. The next question is from the line of Chirag from White Pine. Please go ahead.
Yeah, thanks for the opportunity. Sir, my first question is just a refresh. Sometime back, we were indicated that if the retail business doesn't turn around in a specific time frame, you are looking to shut it down. If I recollect, that time frame was March 25. So are you sticking to it, or it is getting extended, or for the time frame? My memory is not correctly served.
March 25 was not the deadline which we have given. Q1, we said we will look for 8 quarters. That is FY24, we said we will look for 8 quarters and then take a call on it. So we have crossed 3 quarters now. So we are looking at raising funds there, so that, see, the problem in retail is that, yes, it has been making negative losses, but it's not been supported by the losses in terms of cash losses. It's not been supported by cash injection. Whatever they get is purely on the debt front, which again is pulling down the numbers. So,
sorry to interrupt, Balaji. So just to answer this question, this is Chenduran, Joint Managing Director. So just to answer that question, yes, we are seeing progress, and I think even this Q2, we're almost at EBITDA break-even, and even in terms of raising equity, the conversation has been about that. So as you said, we have 2 more quarters, but then we want to extend that because we're seeing progress. And I'm sure with Q3 and Q4, with the significant progress on the EBITDA level numbers, I'm sure we will continue with the retail and the raising of funds. So if it was going negative, if it was getting worse, or the impact is significant, then as you said, definitely there was conversation about what do we do with the retail entity if it affects the parent company. But as of now, we are seeing significant progress on the bottom line as well at the EBITDA level. So we will look at Q3 and Q4, and I'm sure we will see the progress.
Okay, because even if it breaks even, it will still be a suboptimal ROC business for you, and it will take time for you to get to the average ROC Okay, so
Sure.
that's
Sure.
one.
That's why we intend to move it. We're raising funds outside, so it doesn't affect the parent company's ROC, because again, as an industry or as a sector, it is different and it works in a different way. So the first priority is to make sure that the bottom line the negative EBITDA margins doesn't affect the parent company. Once we cross that, and definitely there is going to be work towards improving the ROC, raising money outside and all that. So the parent company's numbers are not affected by retail as a sector.
Okay, this is helpful. Sir, second and a slightly broader question. So if I look at the commentaries over last 2-3 years, the China plus one, etc., now Bangladesh plus China plus one, etc., a lot of these stories have been made, but we are yet to see any proof of conversion happening in terms of revenue or in terms of customer additions in any form. Okay. So where are we in that stage? I understand the approval processes, etc. So they are still looking at SP Apparels and India in general, etc. Or there in next 12 months can we see some proof of pudding? Because some of the peer sets have started seeing those benefits flowing through in their numbers, though at the initial stage, but they have started seeing the benefits. And second, a related question is, if I look at last 3 years, while we have grown our revenues, our EBITDA and PAT number at console level have stagnated. Something or one or the other part of business sees some issues in one of the quarter which drags the overall performance. So at times it is SP UK, at times it is retail, at times it is the garmenting business due to spinning profitability, so and so forth. So do you have a ballpark view on how to look at the businesses where we can see a sustainable earnings growth or a cycle coming across? Because so this is the question that I have.
This is actually, as we all know, that this industry is very dynamic, which has got a lot of risk involvement in terms of foreign currencies, then the government policies, then importing government policies, then labor intensive and raw material fluctuation. So there are so many things involved in this. So it is a big challenge. The garment industry is a big challenge. As you know, definitely this China plus one and Bangladesh plus one is working out in the sense there are a lot of inquiries are coming, and that is the reason why we are talking about increasing our customer base. And it's not a very short-term task. We need to work for at least about 2 years' time to restructure the whole business model to improve everything. But as far as SP Apparels is concerned, we never had a problem of filling the capacities. Our challenge was only increasing the capacities, which now we have, as we said many quarters before that, from 3,600 machine last year by now we are, by end of March 25, our average running will be 4,600. There is a significant growth of at least 15 to 20% growth in the capacity alone. So which is a big thing which we have been able to overcome. So now that, in addition to it, we have acquired Young Brand. This is another, it's inorganic growth by, adding it, quickly, we are able to get another 300 crore of business, and additional 330 crores of business and capacity addition. So this is a quick, if at all we had to achieve those 330 crores of sales in Young Brand, we would have to work for another 2-3 years time to bring that number. So which we got so quickly here. So I think we are very much on the track, and it's a matter of time. And as you said, there are always challenges in SP UK. SP UK is only the post-COVID effect, and all of a sudden it cannot be corrected. And spinning and processing division, they are going okay. That's fine. And retail is a continuous improvement is going on. It was never up and down kind of a thing. And SP Apparels is constantly growing. It has never been flat. There are, of course, like Red Sea issue where the air freight cost gone up. So these things are always there. We have to mitigate. But for so many years, we have been able to maintain around 18 crores of EBITDA. which is a good sign. This company is definitely performing good in spite of so many challenges.
No, so my question, say I'm not disputing the revenue side. The revenue growth has been there, which is good. It's more about EBITDA and profit growth. Ultimately, revenue without EBITDA and profit growth doesn't matter much because it becomes ROC diluted.
Yes, EBITDA, in garment division, we are able to maintain the 18% growth.
So I'm saying across, so I'm looking at consolidated level and not individual business level, because ultimately, you are not having a garment business separately listed, no sir. That's the point I'm trying to drive, that at console level, somehow our profitability has stagnated, and probably you may need to relook at it very closely, how to look at this particular piece. And sir, second question was that if I can know what is your share of business in someone like Primark. I'm not saying how much Primark is contributing to your revenue, but would you be like 5-6% of their supplies?
The contribution says, please come again.
For whatever amount, suppose you supply Primark worth 100 rupees, how much that would be in overall scheme of things for Primark, relevant part of the business, because we don't supply everything. Why I'm asking is, we have 5-6 customers. While we have done well with the single largest customers, why we are not able to scale up with others in terms of our share of business with them? And more importantly, even with Primark, have we hit the roof over there and we can't increase our share of business over there?
So, right. See, everything based on the capacity availability. Whatever capacity we are offering to our existing customers, the business grows with each customer. So that is how it goes. So why we are not able to increase the business with other customers? Because we never had additional capacity to offer to other customers. See, now, for example, Young Brand is additional capacity. Now that is coming for American Eagle and, Jockey and other customers. They are additional customers. And here, from 3,600, now we are talking about 4,500. Now we are bringing in additional new more customers. And we would like to maintain Primark shares as it is today, because we have to give room for the other customers to come in.
Okay. So you said your number of machine count is going from 3,600 to 4,500, right?
Yes.
Okay. And this will happen over next 18 months?
Yes. No, by March 25.
March 25. But it will to get effectively utilized, you need another 6 months, correct?
Yes.
Because there is a
utilization. The utilization of machines from 3,600 last year to 4,500 March 25 for SPEAL, including Sivakasi unit.
Okay. Okay, sir. This is helpful. Thank you very much and all the best.
Yes.
Thank you.
Okay, sir.
We have our next question from the line of Divyanshu Mahavar from Dalal and Broacha. Please go ahead.
Thank you for the opportunity, sir. So just wanted to understand a broader question that how you look at the opportunity on the demand side that is shaping up, especially from the European customers today, after seeing from Bangladesh that outright happens. And if something got, there's a talk in that Bangladesh is going to stabilize more in terms of textile. After that, what would be the organic demand? So how do you see that?
See, it's like this. People have got some kind of a wrong opinion about Bangladesh issue. The retailers, the brands, what they are taking a stance is they will not pull out the business from Bangladesh. They don't want to, because their margins are better. Landed cost is much cheaper than other countries. What they will now do is they will not increase further in Bangladesh. Rather, the additional quantity what they want to increase, that will be done in other countries like Vietnam, India, Sri Lanka, and Pakistan.
Okay. So in this for this opportunity, if you look at this scenario that they are looking for additional capacity in other countries like India and Vietnam, what could be the organic opportunity for us? Like, for an example, we have done young blood acquisition for cross-selling opportunity. What could be the other opportunities you are looking for that in this acquiring the customers in the terms of base?
I'm not able to understand. Can you come again, please?
So, if you look at the companies, they're looking for the additional capacities, not in Bangladesh, but for other countries in India or Vietnam, etc.
Correct.
So, for that ways, if I have to look at for an organic growth, what kind of opportunities you are looking? For an example, you acquired young brands just to have a cross-selling opportunities inside yourself only. So, what could other opportunities you can have? You are looking for, and you can look for it in upcoming years.
See, the new customers of American customers will be looking for big factories with the good capacities, whom we are not working with. So they will also be coming for the additional business. It's not because there are many American importers and brands. They have never been into Indian market for sourcing. So those are coming in and hunting for the big factories. So that's the biggest opportunity.
And one last question, sir. Are there several states like Odisha, Chhattisgarh, Bihar? So if I was going to their industrial policy, they are having a huge amount of subsidies for their textile park. Means in terms of capital subsidy or interest subsidy. So they are calling out like 80% capital subsidy the government is providing to set up the textile plants in state of Chhattisgarh or Odisha or Bihar. So is it a good opportunity for you to move some of their new capex plan towards them, because the labor cost, the low labor cost of that states are very less compared to the Karnataka? I just wanted your view on this.
Yeah, it depends on the management outlook and management capability. See, our stand, what we take as a stand is that at the moment we don't look at other states of India, because we have still enough space to increase the capacity within Tamil Nadu, where like Sivakasi, then in the existing factories we can mobilize more local people also. So at the moment, we don't have any plan to cross the state. Rather, we are crossing the country to Sri Lanka, where, because in India, you cannot get this kind of job working factories approved by the customers. But customers accept Sri Lankan factories because their factories are far, far better than Indian thing in terms of compliances and other things. So why we opted that route is because we do not want to invest further into this one, but to make it, not to make it asset heavy. So Sri Lanka is as good as, Tamil Nadu way of working. So we can immediately get good factories with a skilled workforce and the customers ready to place the orders. So this is the easier way we think, rather than putting up a big factory in northern part or the northeast part of India.
Okay. Thank you, sir.
Thank you. We have our next question from the line of Kiran D from Table Tree. Please go ahead.
Thank you for the opportunity, sir. Sir, if I look at pure garment revenue, we'll probably end up at around 11,100 crore this year, next year. Sir, to go to just focusing on garments, right? To go to let's say 2,000 or 2,500 crore, the delta of 1,000 crore, 1,200 crore, including young brands, excluding young brands, that's fine, sir. But essentially, for that to happen, should we onboard some of the large US players like Carter's or anybody else in the young kid segment? Otherwise, our growth will continue to be 10-12%. Is that a fair assumption?
No, we have to, as I've been mentioning, we have to increase our customer base, add in more customers. And now there is a way for allowing, there is a room for increasing the customer base because the capacity has been increased, without reducing the business of existing customers who are long associated with us for many years. So only way to increase the customers, even though it is American market, only way is to increase the capacity and give room for them to place the orders with us. So that's what we are working on. The shortcut is young brand, where straight away we got 3-4 customers. Same way, if we have another 1,000 machines extra in the next 1 or 2 years' time, so we will be focusing on new customers.
Got it, sir. Got it. Sir, the other question then I have is, from a government perspective, is US going to be, given the demographics of UK and Europe, where young population is probably stabilizing or actually collapsing, is our next growth market primarily going to the US? Should we assume that the UK market will stagnate from here on at whatever 900,000 crore sales, and the next level of growth, the next 1,000 crore is going to come from the US? Is that a fair assumption?
Yeah, see, it's like this. See, one or two customers are confined to only the UK market, UK and Ireland, but other customers are international players. They are into UK, into Europe, they are into US market. So that is a bigger growth. So I think American market is much bigger than the European market. And once we increase the customer base of American customers, then automatically the business will grow. Over a period of time, there could be the more contribution from the American market.
Got it, sir. Sir, the third final question that I have is, if I look at a 10-year history, right? 10-year history, our margins were substantially higher, except for the COVID years. Gross margin again on garmenting only, sir, not on the retail and the SPUK, but just on garmenting, we are about 20 plus. Our competitor, who's based in Kerala, also is probably 20 plus. So just trying to understand, is there more competition coming in the children wear, kids wear, infant wear segment from outside India, which is forcing us to reduce our gross margin, just gross margin, sir? I understand about all the freight and all that for EBITDA, but just on gross margin, is there more competition coming which is forcing us to reduce gross margins, or is this a play on scale where I want more scale, so I have to compromise on gross margins? How is that working in the last 10 years?
It works both ways. See, because even there are a lot of competitors or Indian players are coming in, so there is a controlled competition. There's no doubt about it. But at the same time, economy of scale, that's what we are working by. For the kind of overheads what we are having, so if we increase the top line to say 1,300 crores or something, then definitely we will be able to sustain this competition. So that's our plan.
Got it, sir. So you're saying the competition is also because, from what we understand from the time you've been listed, sir, is that infant wear, children's wear, like the 24 months, 0 to 24 months, is like a insanely labor-intensive process, extremely difficult for competition to get in. Therefore, there are only 2-3 players in India who can actually do such scale. So now what you're saying is, look, over the past, 5-6 years, there are a lot other competition from India that's coming in that 0 to 24 month space. Is that roughly the conclusion?
Yes, slowly, because they also would like to move to a little more complicated styles where the competitors think they can make a little more money. So that we cannot stop. So we re-strategize everything to see how we can maintain this EBITDA margins.
Got it, sir. Got it. Thank you so much. Thank you.
Thank you.
Ladies and gentlemen, that would be the last question for today, and I now hand the conference over to the management for closing comments.
Yes, thanks for the opportunity. I thank all the shareholders who participated in the concall. And as I always say, that please rest assured we have big plans. Re-strategizing the business plans and for the top line growth and the bottom line growth. We are consistently working towards that, despite a lot of challenges in this industry. We are confident we have a long way to go, and we will be able to satisfy all the shareholders. Thank you. Thank you for participating.
Thank you. On behalf of Elara Securities Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.